Well, let's talk about the performance of Divis Lab. When you just look at the performance on a YOY basis, even though it was expected to be strong, they've really managed to deliver on very high expectation. Revenue growth for FY21 was about 29%. This was driven 35% by the generic API business, 16% growth in the CS segment that they have. Q4 results were broadly in line with estimates. Revenue and Ebitda grew by about 29% and 61% respectively. This was aided by capacity expansion, especially in the generic API, the nutraceutical segments, and these businesses have delivered close to about 35 to 86% growth. In FY21 itself, the CS business accounted for 40% of the overall revenue, growing by about 16% in this year. Now, the company has a CAPEX of about 2,500 crores, of which the targeted CAPEX in generic API business is about 700 crores. It is yet to be operationalized. Divis has targeted their CAPEX spend in the generic API business was about 2,500 crores. Company has started to capitalize assets in this particular year. Apart from this, new plants at Kakinada has also received regulatory approvals, and Divis will invest about 600 crores in phase 1 of this project in FY22. Management in the conference call indicated that they are operating with the capacity utilization of 86% across most of their facilities. Now, when we talk about the outlook going ahead, management in the conference call highlighted 4 key pillars for driving the growth of the company in the generic API space. Firstly is the legacy API molecules such as naproxen, levothyroxine, where Divis has global market leadership coming in, and their market share is about 65 to 85%, growing at about 5 to 10% on an annual basis. But there is also an opportunity coming into the newer API molecules, which the management suggests. So various other molecules which they are working on, where Divis only has current market share of about 20-25%, and the management views as an opportunity to increase the market share of this molecule to about 60 to 70% over the years to come. On this, Divis, there is a contrast media segment where Divi has less than 10% of this market, and the overall market itself is growing at about 25%. So Divi sees synergies from the nutraceutical business, which would enable it to get efficiencies in the scale as well. Overall, very, very strong performance coming in. The management highlighting that, really what are the growth pillars of the company, in which segments they already have good market share, and which segments they will go ahead and get good market share. And that is something which probably, the street would have liked. When we talk about the brokerage radar for this particular company, the street has broadly maintained its FY22-23 EPS estimates. The street already was expecting high numbers. They continue to expect a 20% EPS CAGR over the next couple of years. This is led by capacity addition. This is led by growth levers across segment, and Divis EBITDA to operating cash flow conversion also being strong in the past couple of years. So they expect an overall performance in the net working capital, better cash management also to aid the numbers going ahead.